afternoon. I'll be taking you the financial accounting, which is the introduction of financial accounting. And in this class, we're looking at the significance of accounting. We're also looking at the background of financial accounting. And we're also looking at the definition and the users of accounting, the purpose of financial accounting, and that of the accounting equation. So now let's start with the significance of accounting. Now, the significance of accounting is about to show the financial position of an organization. That is to know the performance. That's the essence of financial accounting. How can we measure the accounting in order to ensure that the decision is being made by the users? And what we understand by financial accounting is the art of collecting, recording, classifying, analyzing, and get the financial information to make sure that the users make a decision. And let's look straight to the historical background of the financial accounting. Now, accounting has been in existence when others have been into businesses. That we have traders, because whenever you are doing business, there's something you are able to achieve by this, which is what to make what profit. You need to make a profit in any organization. So now, this historical background has been existing because we are into business day to day. Now, there is a man that introduced what we call this GAAP. This GAAP, it means the generally accepted accounting principles. Generally accepted accounting principles. This was introduced by a man from Italy, which is called Lucia Pasoli, in the year 1494. He introduced this principle. What is the principle all about? The principle is about the double entry principle, which states that for every debit entry, there must be a corresponding credit entry. What does it mean? It means there is one should be plus, the other one should be negative. That is, we have the debit, we have the credit. So the debit is whereby we receive, while the credit is whereby we give. So debit, the receiver, then we credit the giver. So debit is always at the left hand side, while the credit is always at the right hand side. Now we have the procedure, how accounting is being taking place. Now accounting started from bookkeeper. Now who is the bookkeeper? A bookkeeper is the person that record. It's not just only recording, he record and collect the sources of information. What are the sources of information? He record it and classify them inside the source document. What are the source documents? The source documents are the invoice, we have the receipt, then we have the voucher, then we have the subsidiary book. Now, we know that subsidiary book is a book of original entry. So these are the source documents, and the bookkeeper will put all this information in place of this. Now, after that has been done, the accounting will collect the information from that of the bookkeeper. Then when the information is being collected, then the accounting will now classify it, interpret it, summarize it, in order to make an economic decision by the users. Now, how is it done? Look at how accounting is being processed. The procedure. It started from the source document, which is being collected from the bookkeeper. Then after that, it's being collected from the bookkeeper. After that, we have that of the subsidiary book. The subsidiary book. And what are the subsidiary book? That the subsidiary book is a book of original entry. Those books are the sales day book, the cash book, the return inward day book, the return outward day book, and that of the petty cash book and cash book. No. So then from the subsidiary book, then we have what we call the ledger. The ledger. After that, this has been done. Then after the ledger, we will extract our trial balance, because we cannot extract our trial balance without preparing the ledger. So after we have prepared our ledger, we can be able to extract our trial balance from the ledger, which is our next thing. Then we have the trial balance. Then it is trading profit and loss account. Then we have our balance sheet. Then we also have manufacturing account. So now, when that has been done, then what is the next thing to do? Now we have these are the documents, these are the procedures to prepare what our what account. Now the next thing we have to look into is what we call the definition. Now the definition of accounting. What do we understand by accounting? Accounting can be defined as the process of recording, classifying, interpreting, summarizing, analyzing, communication of financial information for decision making by the users. That is for decision making by the users. Now, who are the users? Who are the users? The users of financial accounting, these are the users. Who are the users? The owner of the company, that is the owner of the company, is one of the users. Then we also have the manager. We have the manager. Then we have the employees. Then we have that of the auditors. We have the financial analyst. We have the financial analyst. Then we have that of the management. Now these are the users of the financial accounting. We have the tax authorities. We also have the government. So these are people who are known as the users of financial accounting. By the way, now we understand that without that, it's not only about to make decisions. When we know about decision making, you need to know what the performance of the organization, if they are doing well or not. Then you need to know their financial capability, that's their financial position. You need to know that. Then you need to know how to access their tax, because accounting is not only about to determine the financial resources alone, but also involve how you can access your tax, how to look at the government account, then also how to measure your performance, how to measure your performance as a business, as an organization. Then we need to understand that now that things have now been changed. Before we use this GAAP, which is known as the generally accepted accounting principles. Generally accepted accounting principles. But it has now been changed. It has been changed. It has been developed, which is now known as, we call it IFRS. IFRS. What do we mean by IFRS? The IFRS is known as the International Financial Reporting Standard. The International Financial Reporting Standard. That is, this is being organized in order to ensure that they follow the principles. They are the standards that are used while preparing the financial accounting in every organization, such as where we have the limited liability companies. They need to what? To amend according to this IFRS, which is being amended in the law, which is CAMA, which is the Company Act matter, the Company Allied Matter Act, which need to be amended according to that. Then we have the accounting what? Equation. But before that, let's look at the purpose of financial accounting. Now, the purpose of financial accounting, why do we prepare financial accounting? What's the existence? What's the purpose? The importance of it? Number one, it is for us to know the performance of the organization. The secondly, to know the inflow of how money is being managed, how money is being operated, how the organization is being run. Then the third one is to know the financial position of the organization, if they are capable to continue or not. Then the other one is also to know how the cash flow of the resources, Then we also need to know the liquidity of the cash. That's also one of the purpose of financial accounting, and also to know your debt, how you can manage your debt, how it's being done, which leads us to what we call the debtors and the creditors account. How you can deal with that, how you can settle it. It is through this financial accounting. Then the next thing we have is known as the accounting equation. The accounting equation. Now, what do you mean by the accounting equation? The accounting equation is just talking about the balance sheet. But now it is no longer called the balance sheet in a standard way now. It is now called the statement of financial position. Now, what are those things that are under this statement of financial position? We have the assets. We have the asset, then we have the liability, then we have the capital. Now, how do you calculate equation? Now, when we talk about equation, that means there is something, there is a sign of equal sign there. So, how do we do that? So, it's going to be asset is equals to capital plus liability. Is capital plus liability. Now, what do we mean by asset? Asset is a property that generates more money to you. It's a property, is an equipment or a resources that generate more money to you. And this asset can be classified into two. We have the current asset and we have what we call the non-current asset. Now, the difference between these two is that the current asset also generates income, but it does not last for a long period of time. An example of current asset is what we call the stock. Stock, we have stock, then we also have cash. We have cash and debtors. So, these are examples of current asset. Now, what do you understand by non-current asset? A non-current asset is an asset that generates income but lasts for a long period of time. You can use it for a long period of time. So, an example of non-current assets, we have land and building. We have land and building, equipment, we have machinery, and so on and so forth. Then what do we mean by capital? Capital is the actual amount of money you use to start up a business. The actual amount of money you use to start up a business. That's what we mean by capital. The money you establish, the money you use to start up the business. That is what is called capital. But both of them is known as liability. Why we call this one the long-term liability? Why we call this one the short-term liability? Then what we mean by liability? Liability is when you are owing someone an amount of money you are owing the public, which you need to pay. Because now the capital is maybe you borrow the money from the bank, you need to refund the money. That's maybe used to start up the business. Why this one is maybe someone gets an item from you on you bought an item on credit, but you need to refund the money back. So an example of liability is we have what? Creditors, loan, short-term loan. So bill, payable. All these are examples of what? Liability. Now, there is something I would like you to understand here now, which has been changed, which you need to know in terms of financial accounting. Now, a lot has been changed. Now, according to IFRS, which is now known as the International Financial Reporting Standard. Yeah, then we call it, it's generally accepted accounting principles. Now, before we call this trading, profit and loss account. Now, in International Financial Reporting Standard, it's not only called this, we call it income statement. We call it income statement according to ATS. Now, then we have balance sheet. No longer call it balance sheet, we have that of the statement of financial position. Statement of financial Now we crash flow statement, which is being introduced according to a standard, which is the IFRS, which is also known as the accounting of technician standard. So, yeah, but if you have any